Could the US dollar hyperinflate? What does that actually mean? Is it like inflation on steroids? And most importantly, does it really matter for you? Hyperinflation became kind of a buzzword recently, as it has happened in Venezuela, Argentina, and Lebanon. So it's time to answer all your questions in this video. After watching the next 12 minutes, you'll have learned all the fundamentals and are ready to steer these uncertain financial times with confidence. You'll know what to do if hyperinflation arises and, most importantly, how to protect your wealth. So, what is hyperinflation actually? Hyperinflation is when a currency experiences tremendous rates of inflation. By definition, this rate is at 50%. The value of a currency declines so fast it becomes virtually worthless. When this happens, people will use alternative forms of money or even barter. This means they'll, for example, exchange a box of vegetables for a t-shirt. Let's have a look at a few historical examples in order to better understand if hyperinflation can also arise in the US. The mother of hyperinflation certainly was the Weimar Republic in Germany. This chart shows the perfect example of how quick and dramatic hyperinflation can come. In the chart you can see the number of paper marks required to buy a single gold-backed mark. Yes, in a span of only 5 years, a gold-backed currency that was worth one paper mark was suddenly worth 1 billion of them. Slowly, then suddenly. And all your savings gone. Now, in order to draw conclusions for our current situation, we need to understand what brought hyperinflation. The major driver was the Weimar Republic had to pay war reparations imposed by the Treaty of Versailles. In order to be able to pay these reparations, the government had to print massive amounts of money. This ultimately led to the German mark collapse, with prices doubling every few days by the end of 1923. Aside from the reparation payments, there is more to how a currency can collapse. Mainly, it is poor monetary policy of its government. This means the government builds up a large budget deficit by spending more than earning. Therefore, in order to cover this deficit, the government buys its own bonds to keep up with its debt. Or, to say it in other words, it prints money excessively to be able to buy the bonds. In order to fix the situation in the Weimar Republic and that of many other countries, the Bretton Woods system was introduced. This system meant fixed exchange rates for several currencies, which ultimately were backed by gold, the global reserve money back then. In case you're now wondering if the Weimar Republic is the only example of hyperinflation, let me break it to you. No, it's not. We'll now have a look at other examples in order to better understand the potential threat for your wealth and draw the right conclusions. Next up in the hyperinflation lineup, Zimbabwe. From 2007 to 2009, massive money printing led to financial budget deficits, resulting in hyperinflation in unseen levels. The inflation rate was at 89.76 trillion% per month. You didn't hear that number before? Don't worry, me neither. It's 89.7 followed by 21 zeros per month. Here's a photo of the paper bills, which were ultimately abandoned as they became effectively worthless. As a result, the government of Zimbabwe changed to a multi-currency system, primarily using the US dollar. If you thought it can't get any worse, let me present you Hungary after World War II, the superstar in the hyperinflation business. As a result of the war, the government printed massive amounts of money to repay war debts and finance its reconstruction. Kind of similar to the Weimar Republic or Yugoslavia in the 1990s, here also the effects of war were the major driver for hyperinflation. But wait until you see the levels. It's impressive. Are you ready? The prices in Hungary doubled every 15 hours. This means the Hungarian currency lost more than 90% of its purchasing power every 4 days. Amazing. Here's an example to better understand what this meant. Groceries that cost $100 would cost $204,800 after only a week, and after a month, $280 trillion. Simply mind-blowing. In the end, probably no surprise for you any longer, the currency had been replaced with new money that was pegged to the US dollar, the global reserve currency. From these examples, we can learn that hyperinflation usually arises as a result of a large war and its massive price tags, as well as excessive government spending more than they earn. As a result, new currencies are created, which are often pegged to the global reserve currency. Well, now you might say, well, the US is currently heavily financing a war against Russia, and it is definitely spending more than it is earning, as the debt ceiling has just been raised another time. This gets me really worried. But what about the fact that the US dollar actually is the reserve currency? What will reset do? To better understand this situation and draw the right conclusions from it, we need to take a look at the capital markets. What happens to them before, during, and after hyperinflation? Before hyperinflation, stock prices may initially rise as investors hedge against inflation by investing in companies that hold real assets. However, with rising inflation expectations, markets become increasingly volatile. The housing market might initially increase due to inflation expectations and an increase in building material costs, but demand often declines as uncertainty grows. Gold, oil, and other commodities are more desirable as investors seek hard assets valuable in any currency, hence, their prices might increase. During hyperinflation, stock markets become highly volatile. Many companies will fail due to challenges, and the value of stocks adjusted to inflation will decrease heavily. The same goes for housing. Here, also, inflation-adjusted prices will likely decline. However, only to a certain level, as people will use real estate as hard assets in order to protect their buying power. Other assets, like gold and oil, will keep their value, as they are seen as a store of wealth, and thus demand for them is high. What happens after hyperinflation? As a country introduces a new currency and implements economic reforms, stock markets can start to recover. However, this process can take time and is marked by significant volatility. The housing market can also stabilize as the new currency is introduced. As the economy recovers, home prices may begin to rise at a sustainable pace. Demand for gold and oil will most likely decline as investors regain confidence in the currency and in the financial system. Hence, prices might decline slightly. Okay, now that we have gained a good understanding of what's going to happen in the capital markets, how high is the risk of the US dollar to hyperinflate? Here comes one more very important thing we need to take into account before we can draw a complete conclusion. Bank runs. Countries with hyperinflation typically have a collapse of confidence in the banking system and thus a run on their banks. Investors seeking to buy hard assets withdraw as much cash as possible before banks freeze accounts and refuse withdrawals. This will lead to serious civil unrest and financial loss for the average citizen, as we have seen in Lebanon recently, where banks got robbed in order for people to get their money back. Now, here's the hard truth. Every fiat currency can experience hyperinflation, including the US dollar. However, as the US dollar is the global reserve currency, it is most likely that it will be the last currency in the world to hyperinflate. The reason for this is that newly created currencies are often pegged to the US dollar, as we have seen throughout history. This means the exchange rate is essentially fixed to the US dollar. Therefore, the country issuing the currency will also hold a portion of their debt and reserves in the US dollar, as it assures a certain stability and liquidity. This leads to a high demand for US dollar, and as more and more currencies hyperinflate in the future, which will for sure happen, many fold in the dollar, thus demand for the dollar simply grows. So now you might be relieved and happy to keep your US dollar in your bank account. Not so fast here. It's a complex situation. This means there are other things influencing the dollar to default or not. The major problem is the debt problem of the United States. It can also be described as a death spiral, which simply cannot last forever. Meaning, at a certain point, the debt created by the government cannot be monetized anymore, as investors have decided to buy hard assets instead of US dollar bonds, because the risk of holding them is simply too high. And when this happens, the US dollar has been devalued. Your US dollar savings have become worthless. Then the US dollar will get a reset, debt is gone, and the party starts all over again. Therefore, you definitely want to protect yourself against hyperinflation. But how? Here come the best protection assets in a nutshell. Move your hard-earned money into hard assets like gold, silver, or Bitcoin. Here's one last very important thing. Make sure to really own them. What do I mean by saying this? Buy and hold the assets physically. This means don't only buy a paper contract that assures you are holding gold. Buy the physical gold and silver coins. And regarding Bitcoin, hold your Bitcoin in a cold wallet and do not have them on a central exchange. Do you want to understand why this is so important? And how you can even add an extra layer of security when holding your Bitcoin? Check out my video, How to Protect Your Bitcoin. You will learn all you need to know.